If you are old enough, meaning that if you're in your 50s, then you know the stock market can go up and it can also take a nosedive. To refresh your memory, there was October 19th, 1987. The Dow lost 22% of its value. That is still the largest one-day percentage loss in the Dow. Then there was a tech bubble that burst in 2000. The attack on America, September the 11th, 2001. The financial crisis in 2008 that carried into 2009. And after all of those, the markets came back. They recovered basically what they lost and then went on eventually to set new highs. Never before, though, have we experienced the huge point losses as we've had the past 2 weeks. No one can predict the future, but we can make some educated guesses about the economy and the markets. And that is what we will do as we go around the table. And joining me around the table is Jay Sukitz, Clinical Assistant Professor of Business Administration at the Katz School of Business at the University of Pittsburgh. Jay worked as an investment banker for more than 20 years and has held senior positions at PNC, Solomon Brothers, and E.F. Hutton, just to name a few. Also joining me around the table is Rick Applegate, who is a Senior Financial Advisor and Managing Director of DBR Fiduciary Plan Solutions. He's done a lot of other things in his career as well. Okay, we have a lot to talk about, gentlemen, so let's start with the volatility. It's been huge the last couple of days. Why is there so much volatility, and is it going to continue?
I think because the driving force behind this market are literally computer-driven trading programs. These are traders. These aren't investors. These aren't people like who are sort of fixing up their 401ks. These are day traders, primarily computer-driven day traders, and the most recent kind of this kind of trading has been algorithms that are run by artificial intelligence.
But these are big companies you're talking about.
Well, in some cases they're not. In some cases they're very small trading firms, but they can trade a lot of stock.
But I think there's another point to pick up on what Jay's saying, and that goes back to what you're just citing as to previous historical declines, and that is the word uncertainty.
Yes.
Whenever the market gets uncertain, the average investor does not know what to do and makes the wrong decisions at that moment. And so the volatility increases. Normal VIX activity would be below 20. We were prior, when we were at a peak just a few weeks ago, 3 weeks ago, we were at a VIX of about 11. That shows investor complacency.
For our viewers, the VIX is an indicator of fear on the market, basically.
It is. It's measured by the Chicago Board of Options Exchange. It's a measurement of how much is being bought to protect to the downside. When more is being bought to protect stocks to the downside, the volatility index goes up. So the VIX is the volatility index.
But the market has not been going up, down recently. It's been going up. As a matter of fact, since Donald Trump became president, the Dow has gained roughly, my calculations are correct, 11,000 points, or a 60% plus gain. So, gentlemen, the nosedive that we've been taking the last 2 weeks, is this just an adjustment in the markets?
Well, I don't know that necessarily one can say that because of the coronavirus or some other precipitating event that builds in the fact that we had this correction, but it was long anticipated after 11 years. Ironically, Monday, when we had the huge drop that we did of 7%, that was the anniversary of the beginning of the bull market 11 years ago, and it was also the day that we had the worst point drop since then.
Jay, I have to ask you this question. Are we close to entering a recession now, do you think?
Fundamentally, we shouldn't be. If you look at every fundamental, including employment, including our GDP, including especially the housing sector, and also consumers, they seem to be pretty happy. We shouldn't be close to a recession. But part of the problem is when you have this kind of volatility in the markets and people see their 401ks going down and they see their IRAs going down, part of the problem that comes out of those effects are something called the wealth effect, right? Economists call this the wealth effect. So people see themselves with their net worth shrinking, and so they sort of pull in their horns and stop spending.
We had you on yesterday, and you indicated this could be a very good buying opportunity, even if it is a recession, into certain kinds of stocks. The question, though, as Jay points out, if the wealth has gone down, people don't necessarily have money to buy those stocks.
Well, they do if they're continuing to contribute into the 401k, and that was also part of my comment yesterday about the buying opportunity. It's also dependent on the age. I mean, again, this is not the time period if you're about to retire and need that money for retirement to withdraw it to be investing in the stock market. But it is an opportunity if you're 25, 30, 35 and have a long period ahead till retirement. So my advice would be that in these kinds of dips, again, just what you said, Stacy, at the beginning of this piece about the sell-offs that occurred and the recovery. There's going to be a recovery. So this is an opportunity to continue to buy into those positions consistently. Don't get out of the equity markets. In fact, think about contributing more to your 401k at this time.
You agree very quickly?
I do, and I would say that the worst thing you could do at this time would be to sell. That's probably the worst thing, and that's typically what a naive investor will do. They won't be able to sleep at night, their stomach's churning, so they start selling their portfolio.
Somebody on one of the business channels today said trying to sell right now is like trying to catch a knife as it's falling. You just don't know what could happen.
I would have to agree, yeah.
Gentlemen, thank you so much for being with us around the table, and we'll take a look at the final closing numbers from Wall Street coming up in Business Notes.